Ladies and gentlemen, boys and girls, thanks for tuning in for yet another episode of The Engine Room, a podcast by Token Metrics. Today, we are joined by Jad, one of our quantitative analysts. What's up, Jad?
What's up, Dylan? Thanks for having me. Excited.
Happy to have you, man. You work very closely on a part of Token Metrics that is not only very interesting to me, but is very interesting to a lot of our paid subscribers. I'm, of course, talking about the indexes, the Token Metrics indexes,
hmm
which, in a nutshell, is basically a sample portfolio. You pick whichever exchange you're using to buy crypto, and if you want to trade every day, every week, or every month, the Token Metrics AI will just tell you buy this, not that. It greatly simplifies a lot of investing decisions. It
Exactly.
takes the emotions out of panic selling and things like this.
Exactly.
Um,
So yeah, the main point was basically get these complex tools and make it as simple as possible for any retail trader, anyone who doesn't really want to take his own investment decisions and keep following up with prices and all that. We can supply to them all these complex models and then give them a very simple way to leverage these models and use them for their own portfolio construction.
Perfect. So I've got kind of a big picture question about the indexes, but I suspect we can slice it many different ways. The question is, how does this work? How is AI able to track crypto and know, oh, you need to sell your holding of BNB and instead replace it with Solana and also reduce your holding of Shiba by 50%? What is the math and computer science going on behind the scenes to make that easy for a retail trader to understand?
Yeah, sure. So, first of all, let's start with the basics. Why do you want to construct a portfolio instead of just putting all your money in one coin that you believe it's going to do well? Well, first of all, the main point of constructing a portfolio is to be diversified because you can never
Mhm.
be completely sure about one thing. And as the saying goes, you should never put all your eggs in one basket because if you
Mhm.
end up having a wrong analysis or a wrong decision, it could be very risky to have everything in one asset. So the main point of building a portfolio is to be diversified, to know that you might be very susceptible for errors. So let me mitigate these errors and reduce the risk of having a big error in my portfolio. So first of all, you want to be diversified. Now, when you diversify, there's always this trade-off between the maximum return and reducing risk. Because let's say you have a portfolio of 5 coins. You know for a fact that one of these coins is going to have the best return out of these five, but you could never know it beforehand. So you couldn't have all your money in that one coin. So you end up choosing 5 coins so that if one coin does very poorly, you can offset the loss by another coin that does very well. So the main name of the game here is diversification and play around with your risk reward ratio, which is what leads us to the math. How can we optimize or try to maximize that risk to reward ratio? We want as much reward with as less risk uh,
Mhm.
in theory. So that's where we start going into the math, and to not go into too much detail in the math, I can say it in one big idea, which is how to play probabilities. So now, since at Token Metrics we have a very good proprietary system, which is the TM grade, which has been able to pick out coins that were rallying and that had huge potential to increase. So this TM grade is giving us what coins have a potential to really rally in the short term. So we will look at this TM grade and say, okay, how can we construct a portfolio of a diversified portfolio of coins that have a very high TM grade and that are trading on any type of exchange that you are trading on. So we will look at these TM grades and try to construct a diversified portfolio. And then when these TM grades are changing, it will change the probability of these coins having a very good return, and hence it will change the portfolio allocation and keep doing that and that. So It's essentially all built on probability models. If you want to look more into it, it's usually based on Bayes theory. But essentially, it will give you a diversified portfolio so that you don't take too much risk, while giving you the coins that have the biggest potential to go up.
Yeah, that's completely exciting to me because it's like a use case for AI that I can wrap my head around. Why study complicated charts and get into, valuation math when I can just do whatever an AI tells me to do?
Exactly.
uh,
Yeah. And the thing is, AI is not really a magic thing that is doing his own thing. Some AI models are really obscure and knowing how it works, but most of the machine learning models, they really start off with basic models, and then they keep optimizing themselves with more and more data. But since we have a lot of data, we can really leverage this machine learning approach, and it's
mhm.
been providing great results. And the nice thing is that it keeps improving with time.
So what are some of the most important things that feed the AI? Does it know the chart, for example, or does it have access to on-chain metrics like total volume and things like
So
this? What
yeah,
what
yeah.
Go
So
ahead.
many different metrics, and the way this machine learning works is that it sees all this data set about a specific coin, and it tries to see which features of this data sets are very important in either predicting potential returns or identifying period of up days or down days. So for example, since now in the most recent history, this crypto market has been in a very strong trend.
Hmm.
This AI model was able to identify that, okay, let's look at momentum metrics more than mean reversion metrics, and give the momentum factor more weight than a mean reversion factor. And thus it takes into account all the price data, not really the chart in terms of visually, but all the price data can really tell you if momentum is strong, if momentum is slowing down, if there's a potential reversal coming along. And then you can start looking at additional data like on-chain data or sentiment data and things like that. So mainly based on price, sentiment, on-chain data, try to identify which factor is the most important and then follow that factor.
Hmm. Jad, how would you recommend somebody who already has a token metric subscription start taking advantage of indices if they're not using it already? For example, would you recommend the daily, the weekly, the monthly? How to go from 0 to 1 on using TM indices?
Yeah. So a lot of there's no like one right answer to this. It's going to be really dependent on you, your investment style, how much risk you want to take, and how much taxes are you willing to pay, how much time are you willing to spend buying and selling tokens. So what I mean by that is, so at Token Metrics right now, we have daily, weekly, and monthly indices that rebalance based on this time horizon. So first step, you go there and then you pick the exchange that you have access to. So if I trade only on Coinbase, I want to look at the indices that trade only on Coinbase, which are made of coins that are trading only on Coinbase. Then the second decision comes, okay, do I want a daily portfolio, a weekly portfolio, or a monthly portfolio? There are trade offs. If you want daily portfolio, it's going to be rebalancing or changing coins every single day. So it's going to be more reactive to what is currently happening in terms of prices. But since you will have to be trading every day, you're going to have to spend a lot of time and you're going to have to spend money on transaction fees. Compared
Hmm.
to if you do, let's say, a monthly portfolio, if you're following the monthly time horizon, you will only need to change your portfolio once a month. So you won't need a lot of time tracking your portfolio, and you don't need a lot of transaction fees. However, what if a big change happens within that month, sorry, that you will need to keep track of. We don't do that in a monthly index at Token Metrics. So for me personally, the best trade-off between transaction fees and reaction time and time spent on exchanges would be the weekly portfolios.
Mm-hmm.
And based on your specific index, I personally like to trade the high cap indices, which are made of coins that have a crypto market cap above 30 million, so that, and a high trading volume, so that they are less risky and more liquid compared to the low cap portfolios, which are looking at coins that have less than 30 million market cap, which are very risky. They could have huge potential returns, but also they could have very big losses because they're not very liquid and things like
Mm-hmm.
that.
So yeah, you're saying steer clear of the low cap indices if you're more risk averse.
Yes, and always keep track of what's happening in low caps in case you really want to venture out in this high risk environment. You can look at what coins are being picked in a low cap portfolio, so that if you have a coin that you like, that we provided good research, that had either a good code review or a fundamental score, you can see if it's appearing in low cap indices. If it is appearing in low cap indices, you can be way more confident in saying, okay, I want
Mm-hmm.
to take risk in that specific coin.
Well, that's very good. Jed, thanks for sharing a little bit of insight with us on how token metrics indices work. If to our audience out there, if you subscribe to the Token Metrics newsletter, you can read True Confessions of a KuCoin Trader, which is written by somebody who follows the indexes pretty closely. So yeah, thanks to Jad for joining us and sharing a little bit of wisdom. Appreciate your time, Jad.
Thank you, Dylan. Appreciate it.
See ya.
All right.